As we navigate today's turbulent markets, many of you might be feeling the pressure of rising volatility, sharp sell-offs, and uncertainty about what comes next. Perhaps you've recently watched your portfolio take a hit, or you're wondering how to shield your investments from further downside. That's exactly why we're here today. I want to talk to you about a topic that is fundamental to investing, protecting your portfolio when markets turn against you. I'll be sharing some insights on how to approach risk management and hedging strategies that can make the difference between weathering a downturn and suffering severe losses. Let's start by considering what happens in a prolonged market rally. When stocks and other risky assets keep rising, it's easy to get caught up in the excitement. Investors, including myself at times, can become overconfident and take on more risk than is prudent. This overconfidence often leads to an imbalanced portfolio, one that looks good in the short run but is vulnerable when the market suddenly shifts. The key lesson here is that the calm period can be deceiving. Underneath, risk continues to build, and when that turning point comes, the losses can be significant if you're not prepared. This is why it is important to be aware of not only your risk, but of other market participants as well. Positioning has become a strong factor of what drives the market, and in periods of constant low volatility, it can get to a point where it is just like a bubble waiting to burst. We will dive deeper into this topic in another video. Now, let's talk about what you can do to protect yourself. Hedging can be compared to buying insurance for your investments. Just as you wouldn't drive a car without insurance, you shouldn't manage your portfolio without some form of protection in place. Now, this doesn't mean that you need to buy a perfect one-to-one hedge for every investment. Such an approach is often too expensive and will eat into your gains during good times. Instead, think of hedging as an overlay strategy that provides a safety net. This overlay is designed to cushion your portfolio during a significant market drop without completely sacrificing the opportunity to benefit from a market recovery. One important aspect of this approach is that hedging isn't a set-it-and-forget-it proposition. Markets are always evolving, and so too must your hedging strategy. When markets are calm, the cost of hedging, often in the form of options premiums, is low, and you might be tempted to ignore it. However, when the market starts to show signs of stress, the same hedges can quickly become more expensive or even less effective. Just as the saying goes, be fearful when others are greedy, and greedy when others are fearful. This doesn't necessarily mean you have to sell all your positions on the first gains the market gives you, as markets trend for long periods at a time and can stay irrational for even longer. But when everyone is disregarding protection and FOMO is kicking in, it might be smart to use the opportunity and prepare hedges, just like at the end of 2024. It's also crucial to continuously monitor your positions and be ready to adjust your hedging tactics as conditions change. This might involve rotating between different types of options, or even incorporating trend-following strategies that help capture a rebound while still limiting losses. Speaking of options, let me explain a bit about why they're so central to these strategies. Options are unique because they have a non-linear payoff structure, which means their value doesn't move in a straight line with the underlying asset. Instead, small moves in the market might have little effect, but once the market moves beyond a certain point, the payoff from an option can increase dramatically, a property we refer to as convexity. This convexity is particularly beneficial in times of crisis. For example, purchasing out-of-the-money options might seem like a long shot during normal times, but if a severe market drop occurs, these options can suddenly become very valuable. The point is that even if these options never finish in the money, the rapid repricing of risk in a volatile market can provide substantial protection. Beyond the technical aspects, understanding the human side of investing is just as important. In rising markets, investors tend to ignore warning signs and brush off the need for protection, often labeling hedging as an unnecessary expense. Yet, when the market reverses, emotions like fear and panic take over, and we see many investors making hasty, destructive decisions. Even the most seasoned professionals can get caught off guard by their own biases. That's why having a systematic and disciplined approach to hedging is vital. It helps you avoid emotional decisions and stick to a plan, even when the market becomes chaotic. Another strategy worth highlighting is trend following. Rather than trying to predict the exact moment when a market will reverse, trend following involves monitoring the market's momentum and adjusting your positions accordingly. When you notice that the market is entering a downward trend, you can reduce exposure or even take short positions to mitigate losses. The beauty of trend following is that it's reactive. It responds to what the market is doing right now rather than trying to forecast the future with complete accuracy. This method, when combined with hedging strategies, provides an extra layer of protection. It allows you to capture gains during the recovery phase while simultaneously limiting the damage during the downturn. In practice, an effective risk management strategy is rarely about using a single tool or approach. Instead, it's about combining several techniques to build a robust defense. For example, you might use longer-dated options to secure protection over an extended period, while also employing short-dated options to handle immediate volatility spikes. This dual approach balances cost and protection, ensuring that you're not overpaying for insurance while still maintaining a safety net. The idea is to have a versatile toolkit that can adapt to both gradual market shifts and sudden dramatic events. To do this successfully, it's necessary to monitor various instruments that you can express your hedging needs through, and even more important, scan their Greeks. Keeping an eye on how fixed strike volatility, skew, term structure, and the whole volatility surface change day by day provides you with insights on what the market is doing and if there are any bargains to take advantage of. I also want to touch on how market dynamics and institutional behavior factor into risk management. In periods of market exuberance, many large institutions and hedge funds tend to be short volatility. They bet that the market will remain calm. This creates systemic risk because when a downturn does hit, these positions can force a rapid unwinding of trades, intensifying the sell-off. By understanding this behavior, you can position yourself to take advantage of what's sometimes called the second leg down phenomenon, where an initial drop is followed by a more significant decline. Recognizing these patterns helps in crafting hedging strategies that not only reduce potential losses, but in some cases also allow you to profit from the downturn. In conclusion, what you should take away from this is that successful investing isn't solely about chasing high returns. It's equally about protecting your capital from inevitable downturns. This means continuously adapting your hedging strategy, being mindful of both market conditions and human behavior, and using a mix of tools like options, trend following, and dynamic portfolio adjustments. By doing so, you not only safeguard your investments during crises, but also create opportunities to benefit when the market recovers. It's a balanced, flexible, and disciplined way to approach investing that can help you navigate the unpredictable nature of the financial markets.